The U.S. striking out in a big economic way with fresh sanctions against Russia, including sanctions against some of Putin's relatives, two of his daughters, Sergei Lavrov's daughter, and a number of Russian banks. Hello, everyone. Welcome to the Trish Regan Show. I am Trish. It's good to have you here. I want to remind you that portions of today's program are brought to you by Legacy Precious Metals. There has never been a better time to invest in gold, in precious metals than right now. So go to legacypminvestments.com for more. I mean, we've got news now that two of Vladimir Putin's daughters, whom he's never actually formally acknowledged, but this is from a relationship, a marriage he had back when he was a KGB officer years ago. He did give birth to, or his wife gave birth to two girls. They have now both been sanctioned by President Biden. It's expected that the EU will sanction them as well. This means, of course, that they cannot transact in U.S. dollars. They cannot come to the U.S. They cannot hold any money in U.S. bank accounts. It's believed that there's quite a bit of money that has been kept in the U.S. for both of these women. Also sanctioned, Russia's foreign minister's daughter, Sergei Lavrov's daughter, has been sanctioned. And as I said, two Russian banks, one Alfa Bank, the largest privately owned bank, fourth largest overall, and also Sberbank, which is Russia's largest bank. And it's believed that they are handling 1/3 of the assets in the Russian financial system, $500 billion, it's believed. This is something. I mean, I would sort of argue, why didn't we do this like last week or the week before? This comes on the heels, of course, of Monday's sanctions from the U.S. Treasury Department, which stated that Russia could not pay its interest on any of its outstanding debt via its U.S. dollar accounts. So, you know, they've got bills coming up, right, because they have sovereign debt. They've taken out kind of like, you know, our version of treasuries, and they've got to pay the interest on that debt. Well, already we said you can't pay it in rubles. And so they are trying to pay it in dollars that they held in some banks like JP Morgan. And the U.S. have been allowing it sort of on a case-by-case basis, but those days are over. They have now come out and said, you know what, you're not paying it via those accounts. Those accounts are frozen too. Well, again, I would just say it's about time, right? Like if you're actually trying to influence the situation and you're trying to put economic pressure on, then you should be doing all that you can, theoretically. But we tend to drag our heels on these things. And I would say the problem with sanctions is not only are we dragging our heels and we haven't really thrown everything at them. Heck, I mean, sanctions are worse for Venezuela right now than they are for Russia. And Venezuela has not been bombing cities and, you know, going door to door and killing people and seeing, you know, we've just seen so many horrible things, and it's all going to come out. There are investigations going on. I know people that are doing these investigations into the war crimes. It's all going to come out. But you've got to question why it is that we haven't thrown the kitchen sink at Russia in terms of sanctions. I think that they're probably saying, okay, you know, maybe you can deter him. Maybe you can have this carrot and stick thing. I mean, to me, the carrots are just over, and you want to be as proactive as you can in terms of forcing him out of Ukraine. So sanctions, I think they should work. The problem is, you know, we do them in dribs and drabs, and then there's always these workarounds. There's always been workarounds. I mean, going all the way back to the 1700s. I have a story coming out in AmericanConsequences.com, which is the magazine I publish tomorrow. And it's all about how we've been avoiding sanctions. You know, if you go back to the war between France and Spain and the UK in 1701, guess what? They were still importing Bordeaux wine into the UK, even though the UK was at war, right, with France, and they were doing this by just sending it to Spain and slapping stickers on the bottles, right, and then shipping them in Spanish casks and pretending that the Bordeaux wine came from Spain. I mean, this is what happens in Venezuela today. I have sources that tell me the ships are going to the Caribbean. They change the paperwork and the flags in the Caribbean, and then they send the ships on to Singapore, where the paperwork gets changed again, the flags get changed again, and then eventually it makes its way to China. In other words, there's all these workarounds. And there's a whole bunch of middlemen in the process. And so that's the problem. If we're going to get serious about sanctions, we need to put them all in there, and then we need to actually enforce them. And we need to do that in conjunction, by the way, with the EU, which is still getting its natural gas from Europe. Like, that makes sense. Look, I get it. It's going to be painful. And we all need to recognize that. I mean, it's going to be very painful for Europe, which in turn is painful for us because they are a major trading partner with us. And they're going to have to face the fact that they relied on Russia, stupidly, frankly, that was completely naive, for their natural gas, 45% of their supply. That's going to change. What does it do? It shoots natural gas prices higher, and they rely on natural gas. And it shoots energy prices across the board higher, which means more and more inflation in Europe, more and more inflation back here at home, less trade, etc. You understand, like, this is a domino effect, and it's really just so darn unfortunate because we knew what Putin was capable of. We knew it from Aleppo in Syria, we knew it from Chechnya, and somehow people are just waking up to how bad he really is and what's really happening. It should have been addressed long ago. Anyway, I want to give you a quick shout out to one of our wonderful new sponsors here, the Association of Mature American Citizens. Look, I'm all for being protected, but right now we're in a situation where a lot of people are getting protected that really shouldn't be protected, including, it looks like, with the expiration of Title 42, a lot of illegal immigrants that are coming here, not to mention, corrupt politicians, frankly, I mean, because we've got a few of those that seem to be protected these days as well. Anyway, it is time right now to take a stand to protect conservative values in our beloved country by joining the Association of Mature American Citizens, which is standing up for you, by the way, every single day and your future here in America. AMAC is the conservative voice there in Washington, D.C., throughout the country, that believes in American values, freedom-loving American values that I know you all share. By joining AMAC, you're going to combine efforts with over 2.3 million members who share your values. And here's the good part, you're going to get all kinds of exclusive deals on travel, on cell phone plans, on insurance plans, all kinds of things, hotels, restaurants, all these discounts, and it's only $16 a year. So do me this favor, go to amac.us/Regan, my last name, Regan, and join or renew if you're already a member today. It's just, as I said, $16 a year, amac.us/Regan, Regan. It is time right now to protect your faith, family, and freedom. So join AMAC today by going to amac.us/Regan and taking a stand for America. One of the biggest challenges right now is trying to figure out how to safeguard your money. In other words, what do you do given inflation is so rampant? The world is clearly a much crazier, dangerous place. And one of the things that people keep coming back to, and that you hear over and over and over again from some of the brightest minds in investing, is real estate, which is great so long as you have the time to manage your real estate. Well, what if you could actually do this through an investing vehicle, through a private equity investing vehicle? How does that work? What might the returns look like? We're going to get into all of that today with my friend Charlie Dombeck, who's joining us again from KeyCity Capital. But before we do, I got to just say, Charlie, welcome. I'm looking at some of this data that's come in, and there's been some serious rent increases, which makes total sense to me, right? Total sense given the inflation that we've seen in our economy. And also total sense given the sort of exodus out of some of these very high tax states. But walk us through what's going on, because actually, as I look at this, a lot of these are markets that you guys are invested in.
Yeah, it's been inflation, and inflation has not escaped the multifamily residential rental market. And the statistics for 2021 came out last week, and they're actually quite surprising. The rate of inflation in rental real estate is higher than the actual CPI, which is pushing 8% right now. And what's interesting is overall, rental rate increases approached 13.5% annually last year across the nation. But like any measure, there are markets that performed rather poorly, and there are some markets and some areas that performed exceptionally well. And guess which ones performed very poorly? Everything in a blue state, right? High tax states, states that defunded the police, your upper Northeast, Boston, Washington, D.C., New York City, Chicago, many markets in California where upwards of 70% of every dollar you make goes to some sort of social program, including taxation. So we see population shifts out of there. Where did the markets perform best? Well, everything south of the Mason-Dixon line, those Sunbelt states, performed exceptionally well. And in the markets that we serve, which are primarily Texas, Tennessee, and Florida, we saw massive rent increases. In the corridor between Naples and Tampa, it was 35% overall last year. In Memphis, Tennessee, where we have 1,264 units, it was 29%. In Dallas, Texas, 23%. So if you think about rate of return on an investment, certainly you're not going to get an 18 to 20% rate of return this year like we did the last 3 or 4 years in the S&P 500, but you can find that in multifamily residential real estate, and that's what we do as a specialty here at KeyCity Capital.
So in other words, you're going out there and purchasing these multifamily units, and then maintaining them, collecting the rents, and one can invest in that. With you, I guess one of my questions in light of everything that's happening is like, how do you, Charlie, like continue to make those acquisitions, right? Knowing that the property values are going up so much, the rents are going up so much. I mean, where do you now focus your attention? Because you're right. I mean, it's incredible. Tampa up 35%, Memphis up 29%, Dallas up 23%. I mean, what's the next best place? I mean, where do you go now?
So we keep hitting those same demographic target markets that we've been hitting in the past. Our next large acquisition, for example, is in College Station, Texas, a very fast growing market with very good rent appreciation, very good valuation increases. But the strategy allows us to have access to these value add off market opportunities. We've leapfrogged as a company where in the 4 or 5 years ago, we were buying $15 to $20 million assets. Now, pretty much everything we buy today is an asset with multiple campuses at a valuation between $75 and $150 million. What we have found is there is very little competition at that asset price. There's few other private equity firms that have the balance sheet that allow them to borrow 80 to 125 or 150 million dollars. We've been able to execute on that strategy and find properties that cost more, where there's less competition from other investors. And we always look for value add opportunities where there's a significant amount of deferred maintenance, where we can bring our in-house construction teams in and typically within 12 to 18 months create a 30% spread on equity. Okay. Yeah. So that's the strategy. And these properties are overlooked by your institutional private equity companies because they don't want to take risk on construction. They want to buy a performing asset, typically in the A to B class. And what I tell people is our properties look like a B class asset, but they rent at a C class rate. That's why we have immense demand for our products, because we have a competitive advantage in the marketplace.
Look, I just think, and obviously I've covered financial news and investing for many, many years. It's a smart play because there's the REIT product that's traded publicly that's something else entirely. And then there's sort of the institutional investor class and family office class that's in the hundreds of millions of dollars stratosphere, billionaire stratosphere. And you guys are going after something very, very different. Regular folks, right? Regular Americans that may want to invest in real estate, but don't want to be running the real estate portfolio themselves.
You're absolutely right. And the type of audience that we target that is our ideal client is someone that is in the mass affluent category that's largely underserved by their financial team. And that starts with the financial advisor, who is only able to offer that client stocks, bonds, mutual funds, and ETFs. And we're able to dial down a strategy that is typically only available to the ultra wealthy and make that product available to people that make $250,000 or more a year. And what you get is vastly improved investment performance with these off-market private placements. And you get an embedded tax strategy that typically keeps that income off the 1040 for a number of years.
Okay, I am glad that you brought up tax strategy because it's coming up right now, right around the corner, of course. Tax season, we're here. There's a lot of talk in Washington of raising taxes, kind of creating like a wealth tax on billionaires, like a minimum 20%. That doesn't affect many Americans, but I think there's some concern out there about the rhetoric, right, surrounding taxes, given that this is your specialty, your background. Any sense of where we're heading? I mean, I just get the sense that it's becoming more and more important for people to be vigilant and thoughtful about their tax strategies and their planning, given the rabid, I should say, political environment we're in.
Yeah. If you think about the backdrop of what the Biden administration has tried to do over the last 12 to 18 months is they've put forth a number of proposals to increase marginal rates of taxation and to enact what I would consider generational changing legislation to the tax code, largest tax increase maybe in the history of America. And they've been unsuccessful in getting that legislation across the finish line. And much of that legislation would have affected our target audience, the mass affluent. And they're now struggling to figure out, how can I raise revenues to pay for my social agenda? And they've honed in on the Billionaire Wealth Tax to really try and exact and change the code to what represents the largest tax rate of any civilized nation in the world. And it's troubling. It's troubling not only because we're taxing the people that create jobs, that create wealth for others, that expand the middle class. We are also taxing things that represent unrealized gains. So I'm going to tax you on money you haven't received, and I'm going to force you to come up with the cash flow needed to pay tax on unrealized gains. And in many instances, you might be forced to sell an asset that you wanted to keep in your portfolio. That's unfair. That's not part of the American democratic.
That's the part that kind of bugs me, because, like, I get it, it's not right, and there's a lot, by the way, private equity players, right? They get away with not treating their what I would call income as income, and that's been a loophole, kind of one of those loopholes that's been allowed, right, for a lot of years. So I understand, like, they're trying to close that. They could be a little bit more clean about it. They also are trying to get away from a situation where, people really aren't paying any taxes at all that have tremendous wealth. Yet simultaneously, it's like, gosh, guys, it doesn't really make sense if those gains haven't been realized. But look, we're in that kind of political environment. I guess that's going to continue for a while.
It is going to continue for a while, and I think we're going to see continued proposals moving forward that are going to put pressure on middle America to pony up more revenue on the tax side. And part of the legislation that's a component of this Billionaire Wealth Tax is the Build Back America plan. Essentially, the Billionaire Wealth Tax is an add-on. So I call it the Broke Back Biden tax plan, because it's actually going to affect many people in many instances. And probably the largest impact people are going to see from the Build Back America agenda is the increase in IRS funding, which is $80 billion. And you're going to see an army of tax police that are going to scour our 1040s for additional revenue and additional dollars. And, every dollar of money spent on enforcement, you get $5 back. Hey, I take that investment all day long. So I think we should have compliance, but I don't think we should have an army of accounting police.
That makes sense. And by the way, people worry about what they worry about because there's a concern about, weaponization, if you would, of the IRS. But just, back to the real estate thing, because I think this is so attractive to so many people. If they wanted to invest on their own, it's one way to go. If they want to invest in a fund, they could do something like what you guys are offering. But I guess long term, what do you anticipate by way of real estate returns for somebody who's in your product, in your portfolio? What do you expect them to yield from that?
What I tell people is history has a way of repeating itself, whether it's the Federal Reserve increasing interest rates, and 13 out of the last 16 times we ended up in a recession. But at KeyCity Capital, we're on our 11th successive funds. Our real estate investment funds historically have all generated, over the life of a fund, an average annual rate of return north of 20%. In our most recent fund, that rate of return has been exceptional because of two factors: very strong rent growth, like we just spoke about, but also significant increases in property valuation. Will that continue? Certainly in the Sunbelt states that are our target markets. But more than that, the real estate's going to perform exceptionally well in an inflationary environment. It's going to perform exceptionally well in a recessionary environment where people need a place to live. And a lot of people are getting priced out of single family homes now with the increases in interest rates starting and coming down the pike. So the multifamily asset class, especially in workforce housing, a lot of runway left, a tremendous amount of runway left in the Texas and Florida and Tennessee markets. And that's going to be the focus of our acquisitions moving forward. And what is the absolute worst case? People always ask me, well, if everything falls apart in the world, what is the worst case in terms of investment performance? Well, investors receive a rate of return from basically three components. Investors get a fixed 8% rate of return on their investment that's paid monthly. Think about that compared to a corporate bond or a T-bill or a money market. Well, in excess of those rates. Investors also are treated like a fractional owner of every asset in the fund. They get an 80% share of operating profits from the rents and an 80% share of gains on sale. And when you factor all three components in, along with a tax strategy, you're very easily to get to rates of return north of 18% per annum on average.
Yeah, no, it's really,
That's
really attractive stuff. I mean, I'm impressed with the democratization, if you would, of sort of the private equity industry, that you're thinking outside the box here and bringing more people into the fold. So thank you, as always. It's really good to talk to you, Charlie, and good to get that perspective. Real estate certainly is a really terrific place to be right now. Charlie Dombeck, thank you.
Thank you.
You can get more at keycitycapital.com/my name Trish. So keycitycapital.com/Trish if you want to discover a little bit more about investing with some tax advantages these days. Anyway, so much going on right now. I'm going to get back to sanctions for a minute because I think that, yes, this is the right direction, but we've got to have some follow through and we've got to have some buy-in from the global community. And we've got to actually enforce these sanctions with some kind of vigor. I mean, that's what you need. Too often there are workarounds and it doesn't consequently have the effect that's needed. So let's hope that we're doing everything possible right now because, you know, it's tragic. It really is. It's absolutely tragic what's going on. And it's not good for America, and it's not good for our standing in the world, and it's not good, it's not frankly good for Taiwan. Think about that. Anyway, I will be back tomorrow. I think we're going to talk a little bit more about all of this. It's so good to have you here. I want to remind you, do me a favor, make sure you subscribe to the channel if you're watching on Rumble or on YouTube or on Facebook. Make sure that you do subscribe on Apple iTunes or on Spotify or wherever you get your podcasts, and I'll see you tomorrow.